Okay, Chair Reed. All set for you.
Thank you, Mr. President. Good morning, everybody, and welcome. We have a big agenda today, so I think there are 18 resolutions that we need to get through. So let me call this meeting to order at 9:01 a.m. on October 24th. And do I hear any public comments?
Chair Reed.
Yes.
This is Brian. I'd like to propose a modification to the agenda. One of our staff members will be joining us a little later. So if we could move section 5, which is our financing programs, to follow section 7 on investments, that will give him more time to settle in to present with his team. That's okay with the board.
Okay. Do we need to vote on that, or can we just happily allow that to happen?
Unless there's no one who disagrees, we'll just move forward.
Okay, let's do that.
All right.
So let's see, item number 3, dealing with the consent agenda. Did you want to talk about that, Brian?
Yeah, let me talk through it. A few things here. First of all, just a big apologies in terms of the materials in the docket. I don't think we've had more materials in there than we've had today. So I'm going to work with the team on better structuring these documents, leaving some optional materials for board members to read, just to be more efficient with your time. So my apologies on all of that. So let me work through the 6 resolutions we have on the consent agenda. Then I'll go through the report outs and we'll come back to a motion on the consent agenda. So we've got our meeting minutes from the August 20th, 2025 special meeting. We've got in the board packet our final progress to targets for FY25. We've got the 2026 regular meeting schedule of the board and all of its committees. Thank you, chairs there, for working to set those schedules. We've got an extension for a shared clean energy facilities project in Ellington that you all might recall, so an extension of time to close. We've got several CPACE transactions that are under $500,000 and no more in aggregate than $1 million that would fall on in our process, but as you can see, we're at our limit in aggregate, and we're going to be talking about that today. But we left the materials in the package. And then lastly, this is a little bit of a late addition, but we have a transaction extension for a CPACE project to get to close for a project in East Windsor. So we're going to come back to those resolutions here in a second. Forgive me, that was the slide there that I was working through. So in terms of the report outs, we've got a number of report outs in the materials, including the memo for the staff approvals of transactions under 500,000 and no more in aggregate than $1 million. We've got 2 CPACE transactions that total just shy of $1 million in aggregate, and then 1 energy storage solutions project in Danbury. We've got our report out on staff approved restructurings and write-offs through October 17th of 2025. We've, knock on wood, had no write-offs or restructurings during that period of time. So it's just a report out. We provided in the materials the Q4 of FY25 financial report. This is the note that I sent out last week. We included a new aspect to that abridged report, speaking to risk management. So we're going to talk a little bit more about that today when we get into risk management and compliance. I provided our Q1 progress to targets for FY26. As you can see, we're making great progress towards those FY26 goals. And then I left a number of other things in the package, including our comments to the department deep with respect to the renter utilization study that they are working on per Public Act 25-125. Our team spent quite some time looking back over our 14 years in terms of the investments we've made in projects that involve renters. So it was a really interesting piece of work for our team. We've got the Inclusive Prosperity Capital Q4 of FY25 report. And then we included two reports, totally unsolicited reports that were out in the marketplace. One was a public option for solar K through 12 schools report that was done by several nonprofits. Who knew that Connecticut is the #1 state for solar on schools? We now know from the report, but they do also highlight the work of the Green Bank supporting schools, specifically in environmental justice communities. And then there is a Solar Cities report by a few academics that really digs into the beyond quantitative research that goes on in the marketplace with respect to low to moderate income solar deployment. And this is more of a qualitative conversation, meaning the researchers had conversations with people in these communities to find out why solar was working. And I think the takeaway of that research was something like the qualitative aspects reflect more than the quantitative aspects in terms of why LMI communities pursue solar, meaning having support from the city, voicing support for a campaign is very important in terms of getting people to act, just as an example. So we included all of those meetings, those materials as report outs. So if we can go back to resolutions 1 through 6, I would propose that we approve these consent agenda items.
Do I hear a motion to approve, or first, questions, observations, concerns? Okay.
That's Matt. That's
Okay.
great news about the schools and about the qualitative study about solar and LMI communities, Brian. Both big goals of ours, and shout out to the Solar MAP program. And I'll move resolutions 1 through 6 if there are no other comments or questions.
Thank you, Matt.
Second.
Thank you, John. All in favor?
Aye.
Aye.
Opposed? Abstaining? Excellent. Moving on. Committee updates and recommendations. Is Bert going to join us on this? Or?
Yes, we've got Priyank and Bert who are going to provide us an overview on risk management and compliance. Priyank, you want me to turn it to you?
Yeah, absolutely.
Great, thank
Morning.
you.
Good morning, everyone. So we'll quickly walk the board through the risk management and compliance process that we've implemented over the past year here at the Green Bank. Very first thing is the annual portfolio risk rating project. That's actually going to tie in with the quarterly compliance monitoring. That's bullet point number 3. So I'll cover both of those together. Currently, we're doing compliance monitoring for our project finance loans on a quarterly basis. This involves us collecting compliance certificates, ensuring that loan covenants are met, along with tracking metrics such as the DSCR, ensuring our reserve accounts are fully funded. And in addition to this, we also monitor various other metrics such as energy production, ensuring that the project is producing in line with the expected generation. If there is any shortfall, then we will have a conversation with the borrower to better understand what efforts they're making on the O&M front to address those shortfalls. And then in addition to this, we will also review the collateral to ensure that the appropriate UCC liens have been filed and have not lapsed. If they have, then we'll make sure that we loop in our legal team to get those situated as well. So at a super high level, that's the project finance portfolio risk rating and compliance process. We anticipate doing a formal report out to ACG in calendar year Q3. This aligns with when our borrowers will provide us with year-end audited financials typically. And in the first half of 2026, we'll have a more informal meeting with ACG with regards to this report out to gather feedback from ACG and ensure that we're also in alignment with what ACG has in mind in terms of reporting out. So that's the project finance portfolio. And very briefly, I'll touch on CPACE. CPACE, it's industry standard to not actually have covenants or ongoing reporting requirements. So what we did is we just took a pragmatic approach to risk rating these assets. And what we're doing is tracking a few metrics. So the very first metric is the outstanding lien amount or the loan amount to the municipal appraised value. And we're taking this approach because it's, again, it's just a pragmatic approach. If we order a private appraisal, it's around $3,000 to $4,000 per property, per appraisal per year. So if we have a portfolio of 200 CPACE assets, it just doesn't make financial sense for us to do something super granular. So that's the approach we've taken there. The other metrics with regards to the risk rating for CPACE assets that we're taking into consideration are monitoring repayment history. So this includes, in addition to the CPACE assessment, it includes real estate taxes, and also if there is a senior lender, we make sure that the mortgage is also being paid on time, and that will be a factor in our risk rating model as well. And then the last two items are ensuring confirmation of insurance coverage, so ensuring that the property does have insurance coverage. And then the last metric we intend to risk rate our CPACE assets on is by property type. So I'll give you a quick example here. Nonprofits, for instance, do not have a steady stream of recurring cash flows like an apartment building. So that asset, the nonprofit asset, for example, would be risk rated a lot higher than an apartment building that does have that steady stream of recurring cash flow, which then in turn is able to help pay for the CPACE assessment. So that's risk rating at a super high level. And then the next item I'd like to cover here is our monthly delinquency review meeting. And this meeting consists of stakeholders from the legal department, operations, financing programs, and investments. And we get together every month to essentially discuss the problem credits within our portfolio and create an action plan towards a resolution. We've been making meaningful progress with some of the delinquencies in our portfolio, and the memo that's attached to the board material has much greater details on the delinquencies by project type, and I'm happy to also address any questions if the board has. And lastly, I just want to mention reporting overhaul. So this is something that our data analytics team are currently in the process of overhauling entirely, and this will allow us to provide the board with bespoke, timely, and accurate reporting on a go-forward basis. Currently, we have a proof of concept, and the data analytics team is working on backfilling the data to ensure we have the accurate information for historicals, and also ironing out some of the bugs and enhancing some of the functionality on the dashboards that we've requested. And if there's no questions, I will go to the next slide, please. Wonderful. Very briefly, I'll just give the board an overview here. This is one of the dashboards that we envision being able to automate on a go-forward basis when our data analytics team is able to backfill its data and stress test their process as well in terms of ensuring accurate information is input or outputted. And at a super high level, I just want to highlight to the board here that the very top table shows our loan classification. So as you see that our loans are pretty diversified, with a majority of our loans being commercial and CPACE assets. The table to the right will show the diversification amongst the loans in terms of the technology type. So as you can imagine, solar is a big part of our portfolio, but we do anticipate this getting further diversified as we bring on more projects via environmental infrastructure and also expand potentially the scope of CPACE down the road. And I'm sorry, was there a question? Okay, no worries. Next slide. And this is, again, another slide that just shows a overview of our borrower concentration. The very top table shows the exposure, just our overall exposure. This includes subordinated and senior debt. And then the table on the bottom shows the concentration for subordinated debt. The thing I would like to highlight here is that these are not loans made to a single borrower for a single asset. So these, the underlying debt is backed by several projects in most cases. Obviously, the outlier here being Cargill Falls, where it's just one loan to one entity, but that's also CPA secured. And if there's no questions here, I'll go to the next slide, please. This last slide, sure.
Yeah, it's Tom. First of all, thanks for the work. Thanks for reviewing the process, given current situations with one of our business partners. What I'd like to recommend is going forward as part of this, you're laying out kind of your standards. I'd like to recommend that quarterly, in one of our board meetings, the board meet, and I would say, and I'll defer to the FOI experts here, but I would meet in private executive session to discuss any troubled instances, just because that might involve strategy or how we follow up. And again, I'll defer to my legal colleagues on the phone whether that's possible. But I think it's great that management is putting the time in and evaluating these. But I think that the board, at least quarterly, should discuss just any troubled items that have popped up in the process. And by troubled items, I mean delinquencies or large amounts or things that you've assessed have required at least a partial reserve. That'd be my recommendation on a go forward basis.
This is Lonnie. I totally agree with that. I think it's really important for us all to keep up with all of the possibilities that are happening.
Thank you, Madam Chair.
Great. Yeah, we'll build that in to future board meetings. I think we can do it kind of as we're doing today underneath that executive session item.
And I would just say,
I think
you know,
it's appropriate.
go ahead.
Yeah. Go ahead.
No, totally agree, Tom. And that's exactly the idea that we have in mind with the casting of this dashboard that between investments and operations that we're working on is to get to that quarterly cadence where we are reporting out to the board on all these metrics. And as part of that report out, I would say it's not necessarily likely that we'd have to have an executive session or anything like that quarterly. But as the need may arise, we could go into executive session to discuss any strategies on particularly problematic credits. We have used that in the past. I won't call out any names of credits right now, but we have done that in the past. But it hasn't been on the quarterly cadence that you discussed. It has been on an as needed basis. So we have utilized that in the past.
Yeah, I just think we're big enough now.
Yeah.
And there's risks that are beyond our control that I think the quarterly cadence makes sense. And I also think and I want to make sure, and I'm not saying this isn't happening, so don't take it that way because I'm not trying to infer anything. But I want to make sure that one of our fundamental rights here, I think in some of these credits, probably not all, is board observer rights to understand what they're telling their boards of directors and the like. And I want to make sure that we're taking our advantage of that ourselves so that we're hearing the same things that the respective partners' board of directors are hearing when they're hearing it. Just so that if anything's going on, we're in the know. That's what I would request.
And this is Brian, and just to address Tom's question about freedom of information, I think we can totally make this work. You know, when it comes to portfolio items, all that should be disclosable. If we get to a scenario where we have something live that's not fully negotiated and baked between the counterparties, in that scenario, I could see that being exempt from FOIA, you know, when you have ongoing negotiations, but then all the other information would be, you would probably do in the general meeting and then the executive session for anything that's kind of active in the process of being negotiated.
Like I said, I'll defer to you guys, but I just want to make sure we have advanced warning and advanced knowledge of,
Yeah.
even if you guys have an inkling of something going wrong. And I don't want that to reflect badly on the organization that we're doing business with. I just want to make sure that we're in the know. That's all. So thank you.
Yep, absolutely. Thank you. Thank you for the comments. And the last slide here is just a overview of total Connecticut Green Bank investments since inception to realize losses. As you could see by the chart, the team here has done a great job of managing delinquencies and also in terms of managing losses. So that's the overview here. And as I mentioned, we do intend to provide the board with more enhanced reporting on a go-forward basis as we start getting our systems up and running. So with that said, I'll turn it back over. Otherwise, happy to answer any questions.
Okay.
Let's see. Okay, so we are now moving to the annual comprehensive financial report. Let me see, Jane and Dan, you want me to turn it over there to you?
Thank you. We have received a draft of our FY 25 audit from PKF O'Connor Davies, and they did present this to the ACG on October 7th, where it was recommended that to the board that they approve the draft. I'm going to run you through some 2025 highlights, some actual financial highlights, the required audit communications, and our audit contacts should any of the board members wish to reach out separately. Next slide, please. So overall for 2025, the larger items that stand out are that we had a provision for loan loss increase of $9.5 million. That was primarily due to one borrower experiencing significant financial difficulties. This also resulted in our program loans receivable being decreased by 12.7 as a result of that reserve. Additionally, we have restricted cash increase of $98.5 million and a corresponding unearned revenue increase of $94.8 million. This was primarily due to the NCIF grant that we have received, and the funds are currently frozen. Also, during the year, we implemented GASB 101 as required for compensated absences, and it had no significant change in the prior year. We were pretty much doing the GASB 101 in previous years anyway. Also this year, we did not need to have a federal single audit because our federal expenditures were less than $750,000. Next slide, please. We are going to be receiving an unmodified opinion on the financial statements. The level of responsibility that the auditors take with the other information provided in the ACFR, they do review and have limited responsibility over the required supplementary information. Most of that is related to pension and OPEBs, and also the history section and the statistical section take no responsibility on. Next slide, please. I'm going to run through the financial statements in an overview. On our statement of revenues and expenses and changes in net position, our operating revenues increased by 6.8 million year over year. The big drivers of those are a 2.9 million increase in energy system sales. And the big item there this year was our sale of the Department of Corrections projects. We also had a $1 million increase in interest income, primarily due to interest on our program loans and capitalized interest on CPACE projects in construction. In previous years, the board has approved, our previous meetings, the board has approved a significant number of CPACE projects, which we are in the process of constructing now. In other, we had an increase of 3.6 million, and most of that was due to reimbursements for our energy storage solutions program, CPACE closing fee income, and also development fees on the projects that we've been constructing in the Solar Map program. Offsetting those was a decrease in REC sales of 0.7 million, and that was driven mostly by the pricing of our sale of our non-SHREC RECs in the open market that we have to do every year just before the end of the year. If there aren't any questions, next slide. The operating expenses increased 18.2 million year over year. The big item in here is a 9.5 million increase in our provision for loan losses, and that is primarily due to one borrower who is experiencing significant financial difficulties. We also had a 5 million increase in combined program and general administrative expenses. Most of that is due to an increase in headcount. We've added 10 employees year over year. And also CGB's share of the actuarially determined pension and OPEB liabilities. Also, we had an increase of 2 million in the cost of goods sold for energy systems. That is the offset that you see in revenue for the sales of the Department of Corrections PPA projects. The last item is an increase in grants and incentive programs for 0.9 million, and that was driven by an increase in the residential upfront incentives for our energy storage solutions program. If no questions, next slide. On the non-operating side, we had a 0.7 million increase in interest income on our deposit, where we have had a significant increase in our balances sitting in the state of Connecticut Treasurer short-term investment funds. We have gotten significant funds from loan principal and interest repayments and a couple of payoffs of some of our loans as well. We had a 0.3 decrease in distributions to member, and that was the closeout of our SL2 tax equity program last year. We are now 100% owner of those solar assets. We had a 0.2 million decrease in interest expense, and that will continue to go down as we pay off our long-term debt, except for we have just recently issued our third Green Liberty bond. So we'll see an increase for that next year. We also had a 0.3 increase in the change in fair value of our equity investments. And this was due to a small investment that we have for the one borrower where the company is experiencing severe financial difficulties. So year over year, our net position increased to 180.2 million from 166.1. Also of note is the increase in our assets year over year. We had 102.1 million year over year increase. So we are over 400 million in total assets. We have 98.1 million increase in the restricted assets, and that is primarily for the frozen NCIF funds. We have a 26.2 million increase in our cash and cash equivalents, and this is the cash balance related to mostly the increase for principal and interest repayments on our program loans, and also some payoffs of a couple of larger loans. We had, offsetting those, a 21.8 million decrease in program loans and notes receivable and other investments. And the items driving that are the principal repayments, but also an increase in the provision for loan loss for that one borrower who is experiencing significant financial difficulties. Next slide. Oh, I already spoke to this a little bit. Our net position increased 14.1 year over year. If you look at the components of that, the unrestricted piece increased by 11.9 million, and most of that was driven by the current period operating income. We had a 4 million increase in our restricted for energy programs that was split by a couple of items. 2 million increase in assets that we that are restricted for maintaining loan loss reserves. We also had a 1.4 million increase in assets relating to our bond obligations. Offsetting that, whoops, you go back. We had a decrease in the investment in capital assets, and that will happen every year as the net book values of our solar assets are depreciated. Next slide, please. With respect to the required communications that the auditors will deliver, they point out that the financial statements do use estimates in a number of places, the most significant of which are the net pension and OPEB liabilities, which are provided to us by the state of Connecticut actuaries. Also, the allowance for uncollectible accounts is something, and Priyank kind of alluded to our process to identify items where we would see anything troubling and also put up a reserve. And the other item is our asset retirement obligation that we put on the books for disposal of solar assets as they reach the end of their useful lives. The auditors have said that our disclosures are neutral, consistent, and clear. They have requested management representations from us, and we have provided those to them. They also have found no material uncorrected misstatements, and that PKF O'Connor Davies was independent with respect to preparing and fulfilling the audit requirement for us. Next slide. And our contact this year is Catherine Pontenad, our partner on the audit. And if anybody from the board would like to reach out with any questions to her independently, her contact information is here. With that, I will turn it over for questions if anybody has any. Oh, you want to run through this first?
Yeah, I'll be really quick. Just wanted to highlight that after all the important stuff in Jane's section of the act, where we have our non-financial statistics, our impact report, as we've done for the past several years, this has been reviewed and endorsed by Kestrel Consulting, our green bond verifier, who's very familiar with our methodologies and our approach to impact. They've given it their seal of approval. I want to highlight, well, there are many fun facts in here. I want to highlight to the board that we've crossed the point of $3 billion of investment in Connecticut's green economy. That means we've leveraged the public funds that we've received and generated from our portfolio at a rate of $6.70 for private money for every $1 of green bank money. So great progress, and we'll keep it going in the future.
This is, sorry, if there's no other questions or what have you, and feel free, this is Tom and I serve as chair of the committee, and I I got to meet with the auditors along with the committee a couple weeks back, and they were pretty effusive in their praise of our internal team. I would like to congratulate our team. It's having done this myself professionally for many years, to get through an audit with no comments and glowing reviews, and the ease with which this happened. It's not an easy task. So Jane, to you, your team, and the entire team at the Green Bank, congratulations on this. It's something to be proud of, as I know you are and should be.
Thank you, Tom.
This is Lonnie, haven't our auditors actually given us some awards in the past for the level of the quality of the work that our team produces?
We do actually submit the ACFR to the Government Finance Association, and each year we have for the past, I'm looking at the thing in my office here, the past 11 years, we have received a certificate of achievement. And that is something that goes through a pretty substantial review process with GFOA staff. And it's something that we don't take lightly. And we do actually publish the certificate annually in the front part of the ACFR, so you can see it there. And we will continue and present this one upon approval for getting an award as well.
Terrific. Setting the standard again, Jane.
I hope so. I hope it continues. I want to run out of room on these plaques that are in my office.
Oh, boo-hoo.
Are there any other questions on anything? Okay. With that, I'd like to bring resolution 7 for movement, and that the Board of Directors approves the proposed draft annual comprehensive financial report contingent upon no further adjustments to the financial statements or additional required disclosures which would materially change the financial position of the Green Bank as presented.
I would like to move this one. It's Tom.
Thank you, Tom. Do I hear a second?
I'll second.
I'll second this, Adrian.
Okay. All in favor?
Aye.
Opposed? Abstaining? Okay.
Thank you, Chair Reed.
Thank you. Moving on. I see, is it the next, are we going to talk about the employee handbook and the proposed revisions? Is that up yet, or?
That's correct. And let me see if Joe Buonata is with us.
Hi, good morning. I'm here.
Great, great.
Good morning, everyone. Brian, if you wouldn't mind advancing to the next slide. Hi, everyone. My name is Joe Buonata. I am Associate Director of Operations at the Green Bank. I support Eric Schrago, who's our VP of Operations and is on the line as well this morning. So we are bringing today to the board for consideration an edit to our employee handbook, specifically as it relates to our educational assistance policy. So by way of background, in 2020, the Coronavirus Aid, Relief, and Economic Security Act, which is known as the CARES Act, created a provision allowing employers to make tax-free payments of up to $5,250 per calendar year towards employees' student loans. This provision took effect for calendar year 2021 and was set to expire on December 31st of 2025. So in 2021, with the recommendation of the Audit Compliance and Governance Committee and approval by the Board of Directors, the Green Bank adjusted our educational assistance policy. Historically, we had only supported continuing education, but we adjusted the policy to include student loan reimbursement up to the $5,250. The policy currently allows a cumulative amount of up to $10,000 per employee per calendar year for both student loans and continuing education. So earlier this year in 2025, the One Big Beautiful Bill Act that was passed and made into law made this tax exclusion for student loan reimbursements a permanent part of the tax code. The provision still remains at $5,250 each calendar year, and now requires that it be inflation adjusted each year. So with the support of the ACG committee received at their October 7th meeting a few weeks ago, we are seeking board approval today to remove the December 31st end date in the student loan reimbursement section of our policy and add in the inflation adjustment requirement. So to continue our policy alignment with federal policy. We'll keep the student loan, cumulative student loan and continuing education assistance amount at $10,000. And so the team feels that education assistance in both the form of student loan reimbursements and continuing education assistance has proven to be an important employee benefit and a tool for employee development and retention. And to kind of add some additional color to that statement, for detail, to date, 25 Green Bank staff have received student loan reimbursements ranging from one time to all 5 years that this benefit has been available. Total Green Bank spend has been just over $298,000 across those 25 payments. A representative from each Green Bank department has used this benefit, so ranging from junior employees up to members of our senior leadership team. And 3 of the 25 who've used the benefit have left the Green Bank, including for reasons including pursuing full-time graduate studies or making career transitions. This annualized 3% turnover rate in employees who receive the benefit is lower than our average annual turnover rate of 8% as an organization. 22 of the 25 who have used the benefit remain with the organization, and I'm grateful to be one of those employees. This benefit for me covered the remaining $3,000 of my student loans that were not covered by the Public Service Loan Forgiveness Program, which I qualified for after reaching 10 years of service with the state. So without mentioning the names of other colleagues, just for privacy reasons, I can share that many of the staff who received this benefit have been promoted during their time with the Green Bank, have scored highly on their annual performance reviews, and have been at the front lines of some of our most exciting and innovative programs. And the benefit has largely helped Green Bankers reduce the burden of student debt, be it from their undergraduate or graduate studies, business school or law school. So thanks for your consideration this morning, and happy to take any questions if there are any. Otherwise, I believe the resolution's on the next slide.
There we go. Do I hear a motion to approve Resolution 8?
This is Brenda.
I'll move. This is Kim.
Brenda,
Okay.
I heard yes.
I'll second. This is Kim.
Thank you, Kim. All in favor?
Aye.
Opposed? Abstaining? Okay. Let's see, the next item, the legislative process, I think we're going to hear from James and Brian Farnan. Does that sound right?
Yes, it does. Thank you, Chair Reed. Good morning, everyone. James DeSantos, Legislative Liaison for the Green Bank. Brian Farnan and I prepared this slide, but I'm going to walk through it briefly. In adherence to our legislative process document that we created a few years ago, we're currently in the pre-session process where I am meeting with all senior staff to determine whether or not there's any proactive issues that the Green Bank would like to introduce, propose in the 2026 legislative session. To date, we do not have any that we are proactively pushing, but we will be continuing that process through the month of October and November. The executive branch agencies were required to submit their legislative proposals to OPM by October 1st. I believe all of them have been submitted by now. Thus far, nothing that has been submitted will negatively impact the Green Bank or its mission. And aside from that, there's also legislative concepts from outside the executive branch agency that are currently being shopped around. Once those have a lot more depth to them, we'll be prepared to see if there's any impact to the Green Bank and then discuss it on the next board meeting. The big news over the past week was PURA. As everyone knows, Chairwoman Gillette resigned on October 10th. Governor Lamont had a press conference on October 20th where he announced 4 new members that will be on the Pure Commission. Thomas Wheel, who's currently or was at OCC. He actually hit the ground running this past Tuesday already as the new chair of Pura. David Ercanti is the existing member and will remain. Janice Beecher and Holly Cheeseman have both been appointed and will be onboarded in the next week or two. And David Everett. David Everett is currently going through the vetting process, which means the Mike Karen, who was not reappointed, will remain on for the transition. Another news was the special session was announced for November 12th and 13th. The House will go in on the 12th and the Senate will go in on the 13th. House Bill 5002, that was the big housing bill that Governor Lamont vetoed in June of this year. It's 85% complete if anyone has read the news this morning. So we're interested to see what finally gets into that, but that will be addressed during that session. Also, lawmakers are looking to utilize up to $500 million from the budget surplus in order for a federal shutdown response to keep social service programs running through the month of November. So if there's any question, Brian, Farnan, if there's anything you'd like to add to the slide.
I'm all set. Great job, James.
All right, and any questions, please reach out. Happy to go into more detail and provide information.
Any questions, observations, concerns?
Chair, it's Jody DeCola. Just an observation. I believe the 5th candidate on the Pura list is Everett Smith, not David Everett. So just a name correction there.
Thank you.
That's kind of important.
And of interest to the board, I think, is he's got a background in renewable energy development, including quite a bit of solar, more at the grid scale, but you can read about his company online.
Thank you. Anything else? Any other observations? Okay.
Great. Chair Reed, now is when we are making that little bit of a transition. So we're moving the section 5 to follow section 7. So we're going to pick up now with section 6, which are our incentive programs. And let me see Sergio and Ed, if you're there and can take it over, that would be great.
Oh, that'd be great.
Sure. Thank you, Brian. Thank you, Chair Reed. Can you hear me okay?
I can.
Okay, thank you. So I'm Ed Kranich. I'm Associate Director of Incentives at the Green Bank on the Energy Storage Solutions Program. So we have 8 projects in total to present here. We broke them up into 3 transactions based on the customer. We have Target, Lowe's, and Winstanley Enterprises. So with that, we'll start with Target. So our first batch of projects, 3 ESS projects to be located at 3 different Target stores across Connecticut in Newington, Windsor, and Torrington. The projects are all developed and will be owned by Scale Microgrid Systems. Scale Microgrid Systems joined the Energy Storage Solutions Program in 2024 in the spring, and they have a total of over 46 megawatts of approved projects to date. So they've done quite a few projects, and this will be their in this batch. They'll have a total of 25 projects that they'll own across Energy Storage Solutions. So this batch of projects for 3 Target stores, each system or each of the 3 stores will plan to install a Tesla Megapack 2 XL, which is about 2 megawatts and about 4 megawatt hours that will bring on to the Energy Storage Solutions Program. So if we go to the next slide here, so we just have some information here. They're all in the medium C&I category based on the demand based on the annual peak demand of the system or of the customer of the store. They're all expected to receive about $1.3 million of total performance incentives over a 10-year term, which would be paid by Eversource. That's not Green Bank money. That's just here for for information. And each system that we're seeking approval today for these three will have an upfront incentive of $418,964, and we expect them to be installed sometime around 2028. So they've all begun the interconnection process. They've applied, and they will all need to go into an interconnection study, which can take anywhere from 1 to 2 years. So any questions before we get to the resolution for this one?
Ed, this is Brian.
Sure.
I just want to add some additional information, and I'm going to ask you to speak to the ratepayer impact measure here in a second.
Sure.
Per Public Act 2153 that forms the policy foundation for energy storage solutions, the first objective of the policy is to effectively provide positive net present value to electric ratepayers. So what that means is the legislature wants to see the dispatch of these battery systems to reduce electric rates for all ratepayers. So within the PURA process that Sergio, Ed, Sarah, and the team have been living in now for years, but more recently, the last 3 months, the ratepayer impact measure is the benefit cost analysis focus. It's called the RIM. Anything above 1 essentially means that electric ratepayer costs come down. PURA set a target for the RIM of 1.4 for the program. And so I want to give you all that context because ultimately the success of energy storage solutions relies on the interconnection and actual operations of these CNI systems. Right now, a lot of these systems are locked in the interconnection queue. So the policy would fail if we can't break down the interconnection barrier. So you can see here the install year is 2028. You know, time can kill projects. So I just say that because this is a fundamental policy thing that we've been talking about with legislators, that a barrier that we need to break through is to enable these projects to actually be interconnected so that ratepayers can benefit. Okay, sorry, Ed, wanted to give you that context, give you some time, and then speak to the RIM on the project.
Yeah, sure. Thanks for that context, Brian. And yeah, so this batch of target projects, they each have a ratepayer impact measure. Like Brian said, it needs to be over 1.4. Ratepayer impact measure calculated for these projects based on the total system cost and performance over the years is 2.58. So quite a bit higher than the minimum. However, the Connecticut specific ratepayer impact measure, just for Connecticut ratepayers as opposed to the whole ISO New England, is 1.6. So still well above the minimum threshold for this program, and on average will contribute to boosting the overall ratepayer impact measure for the program. So onto the resolution here.
Are there any questions or concerns or observations? Okay. Do I hear a motion to approve Resolution 15?
So moved,
So
Matt.
moved. Oh,
Second,
Okay.
Matt.
Thank you, Matt. Okay. All in favor?
Aye.
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 Opposed? Abstaining? Okay. Thank you. Moving on. So more, Winstanley, Windsor Locks.
I've got 2 more.
Okay.
Thank you. So this next batch is for 2 projects located at the same location in Windsor Locks. This is It's property that's owned by Win Stanley Enterprises, which is a large commercial space developer in Connecticut. This facility particularly, it's over 1 million square feet, and it's a warehouse center that also includes refrigerated storage, dry storage, and a truck repair facility. And it's currently operated or occupied by CS Grocery Distributor. So they're a large wholesale grocery distributor in the Northeast. This will actually be, so this is 2 Tesla Megapack 2 XLs across 2 meters. There's actually already one project, one Tesla Megapack 2 XL that's already been approved at this facility. So it'll be a total of 3. We're approving 2 additionals today. So that's a total of 3.85 megawatts, 7.7 megawatt hours across the 2 meters. So if we jump to the next slide, we can see the incentives. So the reason that these are 2 different incentives is because we calculate the rebate based on the annual peak demand of the meter. So these different meters have different usage. They're all under the same account, but different, basically different demand savings benefits for the different meters. So that's why one of them is at the small rate, which is $535,080. And the next one is the same $418,964 as the other medium-sized projects. So any additional?
And the rim and rim
right,
CT?
The rim. Let me pull that up. I have that here. So the rim for these projects is 2.39, so similar to the other. And the Connecticut rim is 1.48, so both above the minimum threshold for this program.
Okay, questions, observations, concerns?
Madam Chair, this is Matt. I'm going to abstain on this. We worked on this site. I don't know if Win Stanley's still a client on this site, but not knowing that, I think better to abstain.
Okay, that makes sense. Thank you, Matt. Okay, do I hear a motion to approve Resolution 16?
So moved. This is Adrian.
Thank you, Adrian. Do we hear a second?
It's Brenda, I second.
Thank you, Brenda. Okay, all in favor?
Aye.
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 Opposed? Good. Opposed? Abstaining?
Just me.
Just Matt, for very good reasons. Okay, excellent. So moving on. Let's see, this is
One final one for
All right.
Ed on
This is-
ESS.
okay.
All right.
Good. Go
So
ahead.
this is the final one. So this is 3 projects for a Lowe's distribution center, item 6C. So go to thank you. So the customer is Lowe's, and it's actually it's in Plainfield, Connecticut. So we did actually have a typo in the board materials. It said Plainville. That there was a little confusion among the developer whether it was in Plainville or Plainfield. There's actually a Lowe's store in Plainville, and this is a Plainfield distribution center. It's over 1 million square feet, and it serves the Northeast. So it's a pretty large facility. It's not just a typical Lowe's store. So this project, again, this is going to be 3 Tesla Megapack 2 XL systems that will be installed across 3 meters at this one location. And again, it's a distribution center, not a retail store. So if we jump to the next slide here, we can see the incentives. 2 of them are at the $418,964 based on the annual peak demand of those meters. This location has been in operation for, I believe, 2 years now. So we had over a year of demand history for them. And we always verify the annual peak demand with Eversource directly to make sure that we're calculating it all correctly. And then the other meter has a what we consider large demand, which is over 500 kW of annual peak demand a year. So it ended up getting the lower incentive rate, which is which totaled $350,714. And so the RIM for these projects is for the program-wide RIM, which serves the whole New England network, 2.58. And the RIM CT is 1.6 for these projects. So again, both over the minimum threshold and will certainly help boost the average RIM for the program. And any additional questions?
I have one. Just Ed, why are the regional rims higher in general?
Actually, Brian, maybe you could help,
Yeah, you
help
want me
answer
to
that
take
one a little for that.
Yeah,
Yeah, thank you.
I'll take a stab at it. Matt, there is a study, an AESC study that's done every 3 years that is used by a number of regulators throughout the region, and specifically within our Conservation and Load Management Fund. As an example, they use the assumptions that come from this study. And in the general RIM test, it includes regional DRIPE. I forget what the acronym DRIPE stands for, but
Demand reduction induced price effects.
There you go. Great job, Ed. So it includes that assumption. So if you were to want to focus on what are the benefits to Connecticut ratepayers, you would back out the regional DRIPE and focus only on the Connecticut ratepayer DRIPE. So there's a discussion now within the docket about these assumptions, because it's typical for these benefit cost analyses. It's standard for them to use regional DRIPE, but we're being asked to be held to a higher standard in the ESS program because of that objective that I was speaking to, the positive value to Connecticut ratepayers. So they back out the regional DRIPE in some analyses just to show what that means. And you can see it's a big drop, right, in that PCA.
Yeah.
But Connecticut still holds above 1.4. And as I was saying, anything above 1 is still beneficial to electric ratepayers. So the challenge here is realizing that value for ratepayers. If we can't get through interconnection, then we're not going to be able to realize the value of the public policy for ratepayers.
Right. No, I get the interconnection bottleneck is the big issue, but I mean, I just wonder, is the difference between the regional and Connecticut DRIPE related to Connecticut being a net exporter of power, A, and then B, I think we need a motion to limit acronyms to 3 letters.
Yeah, that was a good one, Ed. Right. Yeah. Why don't we come back, Ed, let's flag it as why the difference between the two and come back, and we'll just send a note to the board on the technicality of the difference because it results in such a big change. We'll come back to you, Matt. It's very technical. You could imagine the consultants who dig into these assumptions. It's a big contributor to the benefits.
Well, the reason I ask isn't esoteric. It's just because, like, being aware of our policy role, it does seem like sometimes that ISO doesn't recognize or monetize all the different values equally that we bring as a state. And so I just wonder if that's part of the discussion.
I'll flag it. We'll come back to you.
And Brian, we have, I believe in the annual report, I want to say it was last year that we started using RIM CT. We have more detailed definitions of all the benefit cost analyses, BCAs, which it is a long list of acronyms. So we can spell all those out too. It's hard to remember.
Very good.
So, any additional questions before we move on?
Okay, so are we still going to vote on this resolution? Brian?
Yes.
Okay,
Yes, and we'll, yeah.
that's what I knew we were doing some alterations, but wanted to make sure. Okay. So do I hear a motion to approve Resolution 17?
So moved, Matt.
Thank you, Matt. Do we hear a second?
Second, Jamie.
Oh, thank you, Jamie. All in favor?
Aye.
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 Opposed? Abstaining? Okay, great.
Thank
See,
you.
moving on. Let's see. I think, is this Bert?
It'll be Bert. and
Investment
David Beach.
updates? Oh,
Yeah,
good.
so it'll be Bert and David Beach, and I see him on the
Excellent.
screen there, and he'll be summarizing our two recent issuances. One, Green Liberty bonds. That last time we had an issuance of Green Liberty bonds was in 2021, and so after that pause from the market, we came back to the market. David will summarize that, as well as the ongoing success of our Green Liberty Notes program. So, David, I'll hand it off to you, and thanks very much, and we can pick it up on the other side with any questions.
Thanks, Bert. Great. Well, I'm excited to be here today. Thank you, Chair Reed. We were able to issue our third Green Liberty bond issuance. We were in the market on September 29th and 30th. I'm happy to be here to give a brief summary of what happened. So on September 29th, we had an exclusive retail order period in which we received more than $8.4 million of retail investment. More than 21% of those final retail investors were Connecticut retail investors. If you look down at the diagram on this slide, anything in green is retail investment. So similar to what we've seen in past issuances, retail investors are really interested in some of the earlier maturities, but there's also a lot of interest in the 2034 maturity. So after the retail order period concluded, and we were able to accept from the $8.4 million of investment, $7 million of the bonds, which is nearly 40% from retail investors. September 30th, we went out to an institutional order period. In that order period, our climate bond certification was a strong thing that attracted a lot of institutional support. And that interest, sometimes called a green premium or a greenium, combined with that strong retail support from the day before, allowed us to reduce the yield on 11 of the 12 maturities for these bonds, which I think is just a really great testament to the interest and support for the Green Bank and green bonds in general. So the net result of all of this was more than $16 million to the Green Bank after putting money away in the SCARF and covering issuance costs. We'll kind of turn it over for any questions, but just first want to highlight that this came together with a lot of work from different team members internally and a lot of help from different firms externally. Don't have time to highlight them all, but do want to thank the Treasurer's Office and Kim Morris from our board, who was a big help in our SCARF approval. So
Pleasure.
happy to answer any
Congratulations.
questions. Thank you.
Do you have any, I know it's at some point, Texas has bought our bonds. Do you have any information like that of unusual purchasers?
That's a good question. I don't have a particular one for you today, though there was strong support from all over the country. I will also highlight that we had some really strong investment from bond or green funds at different wealth managers. So JP Morgan Wealth Management had a green fund, Goldman Sachs, Nuvian Asset Management, and a lot of these sort of like green funds that asset managers had were big investors in the Green Liberty bonds. So I don't have a fun state, but that's a fun anecdote.
What I do want to point out is this points out the strength of the Green Bank for in these really these smaller size issuances, and gives us confidence as we start to expand programmatically into community financing, which we're planning over the next year or so. So it's a good success to have in the market.
No, and we're growing our brand, which is great. I mean, it's great to know the national reputation that we have is for real, so it's terrific. Congratulations to the team.
Great, thank you. David, let's move on to the Green Liberty Notes.
Great, go ahead. So we just issued our 14th Green Liberty Note. We're in the market with these about every quarter. Just to refresh folks' memory, Green Liberty Notes function kind of like a green form of a CD. We don't have FDIC insurance backing, but you get your money back after a year with interest. So this is our 12th consecutive time selling out, which means we received as much or more investment than we were accepting. In total, we've received more than 1,300 individual investments from more than 500 investors. And more than 800 of those investments came in original increments of $1,000 or less, which the minimum purchase price for a Green Liberty bond is $1,000. So this really expands our reach to folks who may not have a broker or the ability to purchase a green bond on the municipal market where we issue the Green Liberty bonds. They have an opportunity to invest with us here. And we have, through this program, received investment from more than 40 states and territories. And just wanted to highlight that, we've done 14 of these now. We've really built a strong foundation of understanding how to issue investments on crowdfunding platforms, how to manage that internally, and have built some strong relationships with Raise Green and now Honeycomb Credit, who we partner with. And I think that builds a strong foundation for, as Bert just kind of mentioned and hinted at, the ability to drive further community investment in alignment with our comprehensive plan. So that, maybe looks like something in the future where community members could actually invest with the Green Bank in a project that's going to affect their local community, which would be exciting. And we just have one more slide here. A great thing about the Honeycomb website is that there's a discussion sort of forum there where folks can ask questions to the Green Bank, or they can also just share their thoughts. And we've been hearing some great things from investors. I don't know if I'll sit here and read through all of them, but some really exciting things about people wanting to make a difference with their investments and support investments along with their values, and appreciated the opportunity in our current time to be able to invest in solutions and green opportunities in their state. So just wanted to highlight some of the exciting things we've heard from investors. And that's it for my update on the Green Liberty Notes, but happy to answer any questions if there are any.
This is John Harity. This is just a comment that a lot of people are looking to invest in places other than in oil. And there's an institutional push to get away from putting big funds into oil companies. And so this is a great alternative. I mean, it's exactly the opposite of investing in Exxon. So it's terrific.
Madam Chair, I have a question as well. Long ago, I know we had a conversation about whether there was a way to work with the Chet 529 plans to get some sort of Green Bank related investment option available to people. It just seemed like a natural nexus. And I know we haven't talked about it in a while, but is there any effort, kind of to John's point of it would just be an expanded way that people could invest in this, and probably the people who are investing in their 529s, might like the opportunity to invest in something like this. It's also, future looking.
That's a
We
great
have-
idea. We haven't made a specific push for that, but go ahead, Bert.
Yeah, we have actually received a request or two over the last 3 years. Every time we've made a run at it, Matt, it's been really a thicket of either regulatory issues or others that has prevented us from joining that up. We'll raise it to the Honeycomb folks in our next meeting with them. We'd like to see if we could bridge that, but so far we haven't been able to knock down that wall.
Okay, thanks.
I love it though that our issuance was sold out. Headline there. Any more
That's
questions? Okay, so moving on to now we're going to deal with item 5, which we had postponed. And that would be financing programs, updates, and recommendations. Is Mackie Dykes available?
Yes, thank you, Chair Reed.
Oh, good.
I'm gonna get us started. Then I'm gonna kick it over to Emily Basham. I will apologize in advance. I am calling in from an airport. It's right now a quiet corner of the airport, and hopefully it will remain so. But in case there's any background noise, that's what it is. Next slide, please. We're very excited to bring this opportunity forward today. This is the first solar loan that we have ready to go. I'm going to talk a little bit about that product because it's been a while since the board approved the product and structure. So we started work on this because there were a few gaps in the market that our primary solar financing tool, CPACE, was not able to address. The two primary areas are commercial properties that have a small business administration from the federal government loan on them. They do not consent currently to CPACE. And the other sector is the affordable multifamily sector. There's often complex financing in place on those properties, and many of those lenders or programs that are involved also cannot consent to CPACE. So when the new NRES and RRES solar programs became available in the state, we saw an opportunity with the buy all, sell all tariff that was offered through those programs to develop a financing product around them that would allow us to offer favorable terms without the CPACE security. Try to be brief, but at a high level, the buy all sell all tariff is a structure where the solar sells directly, it's connected directly to the grid and sells the power directly to the utility, who, that's a very reliable counterparty in terms of expecting payment from them for that power. So in terms of our loan, we loan the money to the property owner in order to purchase the solar system, but we take 100% of the revenue initially from the solar system from the utility. So that's paid to us. So we can be assured that, again, because as opposed to our counterparty for the loan, who might not be a credit, have quite the credit quality of the utility, we can be assured that the utility will pay us for that power that's produced. So we take 100% of the revenue. We pay ourselves the debt service, and then we return the rest to the property owner. So that plus a purchase money security interest lien on the equipment gives us, it's not CPACE. We're not able to offer as quite attractive terms, but it is, you can see we do 18-year terms at a minimum of 5.4 interest rate. So it is an attractive product to help property owners go solar. And there's another unique aspect, particular for affordable multifamily properties. As you might remember, the solar program there requires benefits from the projects to be shared with the tenants as well as the property owner. In the case of certain properties where the tenants do not pay their electric bills, that benefit is done through an improvement to the property. And through this loan structure, the Green Bank can actually also finance, in addition to the solar, that improvement to the property. So we take the 20-year revenue stream of the solar. We take assignment of the tenant portion of that, and we use that to sort of bring it forward and rewrite a check to cover an eligible improvement to the property, which is the case for this first one that we'll be presenting here. So with that overview to the product, I'm going to turn it over to Emily Basham to talk through our first project.
Thanks, Mackie. Good morning, board. I'm Emily Basham. I'm a director on Mackie's team with the Solar Map program. We're excited to bring this project to you. This is our New Horizons Village project. It's a 112-unit affordable housing facility that provides housing to individuals with disabilities. It's located on a 25-acre parcel at 37 Bliss Memorial Road in Unionville, Connecticut, which is in Farmington. This property was acquired in the 1960s by New Horizon, Inc., which is a 501c3 nonprofit providing affordable housing, transportation, medical rehab, and long-term care for seniors and adults with disabilities. They're seeking to do a 1,108 kilowatt rooftop solar installation. This facility is 100% affordable multifamily. It's a master metered building, residential building, comprising of 2 facilities. As Mackie mentioned, it qualifies for the RRES program as an affordable multifamily property. It's on the Tier 2 property list of eligibility, which is eligibility list furnished by the utilities. This project comes through the Solar Marketplace Assistance Program Plus, or Solar Map. So it was developed in-house by Katie Shelton on our team, and the contractor was selected through a competitive RFP that we administered. The property owner selected Earthlight as their contractor and O&M provider. Next slide. So they are seeking to be the first to use our affordable multifamily solar loan for a loan size of $4,070,224. This is an 18-year term at 5.4% interest rate. And this is for the installation, the solar installation, and the upfront improvement to the property because this is a master metered property. So per the RRES program rules that require that the solar benefit goes towards the tenants, 25% of the net present value of the tariff is the tenant benefit. So that equals for this project about $1.19 million. And that's used for an upfront tenant improvement at the facility. If the property was not master metered but individually metered, the tenants would receive their benefit directly from the utility with an on-bill credit. But because this is master metered and the property owner pays the bills, there is an upfront tenant improvement that is made to the facility to provide a benefit to the tenants. For this property, they're still finalizing, but their measure selection, they've indicated doing energy efficient appliances and potentially some other eligible measures to reach the $1.1 million. The total combined cost of the project is $4.19 million and requires about $120,000 equity down payment from the borrower. The average DSCR over the term is 1.6. And the RRES incentive for this project has not been secured yet in our program development process. the contractor is responsible for that as part of their work scope. Next slide. So the solar loan uses the tariff revenue to repay the debt service payment for the loan. We can see here for this project's cash flow, the project meets the risk management requirements that we have for the solar loan. So the tariff amount is forecasted to cover the debt service payments. We see the annual DSCR exceeds that minimum 1.2, and the average over the term is 1.46. Mackie noted the loan includes 100% assignment of the tariff revenues, and there is a biannual true-up that we will do as well. In the case that the tariff payment is not enough to cover the debt payments, the property owner is still responsible for making those payments. However, for this project, in the unlikely scenario that, let's say the project generated no RES revenue at all, the net operating income from the property owner, the parent entity, is sufficient to service the loan, the solar loan debt. So due to that, Green Bank staff recommends approving this transaction. With that, I will open up for any questions.
Emily, this is Matt. Just on like an annual basis, so the buy-all is sort of that fixed price, throughout the life of the buy-all agreement, right? So every year it's it's the same value for the kilowatts, right?
Correct. Yep, it's a fixed rate over the term.
So just, do you know, like roughly on an annual basis, what percentage of the credit or revenue goes to debt service and what percent goes to the host? Like, is 80% of it goes to pay debt service and 20 goes to the host, or just roughly?
Yep, well, we know 25% goes to the tenant. And if anyone on the investments team can find this faster than me.
If you go to the previous slide, it actually shows the tariff revenue, which is around 412,000, and then the expected annual debt service is around 315,000, starting in year 3 after the ITC pay down. So that's gives you just roughly the ratio there, Matt.
Okay. All right, I can figure it out. Thank you. I just was kind of curious about the value, relative value for the host. But this is great. I mean, I know this affordable housing has been such a hard nut to crack. So glad we found a way to have an attractive product.
Yeah, I'm very excited about that. I mean, this is innovation upon innovation, taking the RES affordable multifamily policy and the master metered approach there to bring property benefits, and then layering on top of that this innovative solar loan structure. So yeah, I'm very excited about this. Those two things coming together with this project.
This is Lonnie. Under this master meter structure, is there an opportunity to let the tenants know the benefits they're receiving? I mean, they can, since they're not getting it on their own, so that you can let them know along the way of the benefits they're receiving.
Yes, definitely. They will see it happening. They will see the energy efficient appliances installed on their property for this project. And there's a list of eligible measures that are available for property owners to select from and get input from their tenants about which ones they would want to receive from their building. And so those are things, like security improvements, green spaces, counseling services. So these are all things that they would, receive or benefit.
That's great. Any more questions? Do I hear a motion to approve Resolution 9?
So move, John Hardy.
Thank you, John. Do I hear a second?
This is Dominic. Brenda, second.
Okay, thank you. All in favor?
Aye.
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 Opposed? Abstaining? Okay. So I think that concludes our agenda, but we're going to go into executive session.
No, yeah, no, Chairman Reed, we have a couple of CPACE projects to present.
Oh,
These
sorry. Go. Do it.
That's okay. The first one, and I'm Catherine Duncan. I'm a director on Mackey's team for CPACE. The first project we refer to as BT 2008. It's at 414 Berlin Turnpike. The project is a multifamily project that will have 5 essentially identical buildings. They're not all built yet, and 5 essentially identical solar arrays. 20% of the apartments will be affordable. The company BT 2008 is owned 50% by the Dodadio family and 50% by an individual. The company is managed by Peter Dodadio. According to Peter, so far, the equity's gone in first to the tune of about $19 million. Wells Fargo is the senior construction lender and has agreed to consent to CPACE. One of the 5 buildings has a certificate of occupancy and is leasing apartments already. A second building expects to have a certificate next month and begin leasing. A third building is underway. A fourth building, according to Peter, as of yesterday, will have footings and framing started next week. And then the final building will break ground in January. We're seeking approval for all 5 arrays right away today in this meeting. It's all one parcel. I don't know if I mentioned that. So despite the fact that they'll be built out over the several months to a year, the owner understands that, doing it this way could potentially increase his construction interest costs, but he has done the math and figures this is his best opportunity. So we expect we'll close. We may close in one transaction. We may close as 2 or 3. It really depends. Everything needs to roll out with more clarity, because with each individual array, before we finance them, we need to do some additional, final clarification on the SIR and the technicalities of the design when the roofs are ready. Next slide, please. So the total benefit assessment would be 1.9 million. It's a 20-year loan term. We gave him an exception interest rate at 5.25% with construction at 5%. This was covered in the memo, but if folks want to ask questions about that, I can answer them, at the end. All 5 tariffs have been secured by now. They're all buy-all tariffs. And each array is 140 kW. The project metrics, you can see they're pretty strong. The loan to value will be 66.5. Lean to value is a mere 2.3, and it's a healthy DSCR at 1.32. And the SAR is 1.34, for all 5 projects combined. And now I have to apologize. We had an error in the last 2 lines at the bottom of that slide. So I just put a little Band-Aid over that. We had the cash flow right, but we picked up from an earlier spreadsheet the wrong investment, and then that obviously impacted the SIR. So the numbers that you see in the colorful box on the lower right-hand side are accurate. You can also see the annual SIR is positive every year. So no sculpting was discussed. And does anyone have any questions before we move to the resolution? then Chair Reed.
Do I hear a motion to approve Resolution 10?
So moved. Matt.
Thank you, Matt. Do I hear a second?
Second, Joe.
Thank you, Joe. All in favor?
Aye.
Aye.
Aye. Opposed? Abstaining? Excellent. Okay.
All right, I'm going to take the next one. Hi, my name is Stephanie Etruria. I work on the financing programs team as well. The next C-PACE transaction we're presenting is at a shopping plaza in Colchester, owned by Shar Realty LLC. This property is fully tenant occupied with 16 tenants ranging from restaurants, retail stores, including CVS, Dime Bank, and other small local businesses. The owners of Shar Realty, Rick and Sandra Shar, acquired the property in 2022 from a family member who owned it and operated the property since 1988. This project consists of a roof replacement and a 185 kilowatt rooftop solar array. They have secured a buy-all-sell-all incentive tariff with Eversource. Shar Realty is requesting a 20-year loan term for $556,000 in financing at 5.25%. The DSCR is 4.24, and the loan to value is 25%, and the lien to value is 9%. Next slide, please. The overall savings to investment ratio, or SIR, is 1.14 for a standard mortgage repayment schedule. There's positive cash flows from years 1 through 6 and negative cash flows from years 7 through 20. For that reason, we also presented the sculpted repayment option to the customer. Next slide, please. For the sculpted repayment option, where the ITC is applied against the loan in year 2, the overall SIR is 1.24, and the cash flows are positive except for year 2. We presented both options to the customer, and we're just waiting for his confirmation on which option he'd like to go with. Any questions on this transaction?
Okay, I don't hear any questions. Do I hear a motion to approve Resolution 11?
I'll make that motion. It's Joe.
Hey, thank you, Joe. Do I hear a second?
This is Brenda. I'll second.
Thank you. All in favor?
Aye.
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 Opposed? Abstaining? Okay. Next transaction.
All right, our last C-PACE transaction is at a mixed-use office and industrial building located in Oxford, owned by Huizinga Properties. This building is primarily owner-occupied with 2 tenants making up about 20% of the space. The owners of Huizinga Properties, Ted and John Huizinga, also own Eastern Mechanical Services that operates out of this building. EMS is a full-service commercial mechanical company that specializes in plumbing, HVAC, and fire protection. They've been in the business for about 40 years with great success. Their project consists of 2 rooftop solar arrays on 2 separate buildings. On Building A, which is the office-looking building in front, we'll have a 114 kilowatt solar system. And on Building B, which is the building behind it, there would be a 84 kilowatt rooftop solar array. They have secured a netting tariff incentive award for each building with Eversource. Huizinga Properties is requesting a 10-year loan for $567,000 at 4.75%. Eastern Mechanical Services will be a co-borrower on the loan. The DSCR is 1.08 for the property entity and 8.21 for the operating company, with a loan to value of 83% and lien to value of 26%. Next slide, please. For a standard mortgage repayment schedule, the customer's overall SIR is 1.85 with positive cash flows in the first 2 years and negative cash flows in the remaining years. Next slide. We also presented the sculpted repayment option to the borrower where the ITC is applied in year 2. The SIR increased to 1.94 and the cash flows are positive except for year 2. We presented both options to the borrower and he decided to go with the sculpted repayment option. Any questions on this transaction?
Okay, hearing no questions. Do I hear a motion to approve Resolution 12?
So moved, Matt.
Thank you, Matt. Do I hear a second?
Second, Jamie Cosgrove.
Thank you, Jamie Cosgrove. All in favor?
Aye.
Aye. Opposed? Opposed? Abstaining? Excellent.
Great. Chair Reed, this is Brian. We have 2 more agenda items before we get to executive session. What I'm going to recommend is that we move agenda item 5F to the December meeting so that we can work through 5E now and have 15 minutes in executive session.
Okay, do we have to vote on that or can we just do that?
Well, we'd have to vote on the executive session.
Oh, yeah, that I know, but on moving agenda item F to December.
I think if there's no concern about it, some people would say it's a best practice to vote on it. I'm of the belief that so long as there's no concern about it or no one's voicing any kind of angst on it, it's okay to just do.
Okay, so Brian blessed it, so. So then this next discussion is actually because of all the success our team is having. Brian, did you want to talk about that?
We're going to have Mac. There you go, Mac.
Mac,
Yes, this
okay.
is Mackie Dykes. I'll step in again, and I appreciate that framing. Thanks, you, Chair Reed. So this is a recommendation coming through both the deployment and audit compliance and governance committees to increase the aggregate staff approval authority to 2 million. So currently, staff has the ability to approve individual financing program projects, which has primarily been CPACE projects, but could start to include solar loan as we see more of those. Those individual projects up to an amount of 500,000 for an aggregate total of 1 million. This is an authority that goes back to the very beginning of the Green Bank back in the CEFIA days. It was a little smaller on both the project level and aggregate level back then, but it's been slowly expanded. And it actually goes back to the Clean Energy Fund days. It was carried over from there. Since the Green Bank side, since the authority was given to staff, we have approved 137 projects for a total funding amount of almost 23.6 million. We have a very robust process in place that is actually the same as the process to bring projects forward to you and the deployment committee. They go through the same underwriting process, the same metrics apply to them, the exact same materials are produced, and then those are sent around to the staff that's in charge of authorizing the staff approvals. Since we've had this authority, we have cleared the queue. So the way the queue works is, we can continue approving eligible projects up till we hit 1 million. And then once we hit that, we cannot approve more projects until we come to either deployment or board and update on what we've approved. Then the queue is cleared and we're free to start approving projects. So we've done that 53 times. And for 18 of those times, there hasn't been room for another full-size project, meaning that has limited our ability to approve these smaller projects. And we've had to delay until we could bring them to a board or deployment committee meeting and take your valuable time presenting these projects that could have been done at the staff level. So because of that sort of retroactive reason, and also looking ahead for the next couple of months, we're experiencing a large amount of volume, sort of a lump in our pipeline that's moving through due to the recent changes to the investment tax credit. Many borrowers are looking to get financing in place before the end of the year so they can safe harbor their projects prior to these ITC changes happening. We've got dozens of solar projects under 500,000 in the pipeline. So we'd like to be able to make sure we can deal with those in a timely manner. And given the track record of managing the staff approval appropriately and our continuously growing goals, we feel like this increase is justified. And I can turn it back to you, Chair Reed.
Okay. Questions, concerns, observations? Okay. Do I hear a motion to approve Resolution 13?
Motion to approve, Jamie Cosgrove.
Thank you, Jamie Cosgrove. Do I hear a second?
Second, Matt.
Matt, thank you. Okay, all in favor?
Aye.
Aye.
Opposed? Abstaining? Okay. So
Excellent.
that concludes the public agenda, the public part of our meeting. And we do need a motion to go into executive session.
Exactly. Yes.
I
So
make a
we need
motion.
it.
Who was
Excellent.
that?
That was Brenda.
Brenda. Oh, good. Hi, Brenda.
Great, thank you. And just to clarify, just to be on the record, so we would go into executive session per matters related to trade secrets and commercial information given in confidence, as well as personnel related matters. So we have Brenda with the motion to go into executive session, and let's see if there's a second, and then we'll vote, and then I'll do some finagling on my end.
Okay, do we hear a second?
This is Dominic. I'll second.
Thank you, Dominic. All in favor?
Aye.
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 Opposed? Thank you. Opposed? Abstaining? Okay, into executive session we go.
Okay, great. So give me 1 second to double check. I'm going to turn the camera off, and then Eric and I are going to make sure we have the right people. Give me 1 second.
CTN, if you guys can drop off, we'll reach out when we're out of executive session.
Okay. Let's give it a minute, Alani. We're back in public session. Let's just give it 1 minute for others who may want to join us. We're pinging a few people. We'll go from there.
Here's CTN's contact.
Give it a minute. Okay. Okay, Lonnie, we'll turn it back to you on resolution 18 for the board.
Okay, so we're back in public session. Do I hear a motion to approve resolution 18?
This is Brenda. I make the motion.
Thank you, Brenda. Do I hear a second?
A second, John Hardy.
Thank you, John. All in favor?
Aye.
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 Opposed? Abstaining? Okay. Okay, so Unless there's another item that's going to leap in front of us, I think that concludes our agenda today, right? So I get to adjourn. Do I hear a motion to adjourn?
So moved.
Do I hear a second?
Second.
Okay, all in favor?
Aye.
Aye.
Opposed? Abstaining? Have a great weekend, everybody, and thanks for hanging in there because this was an important meeting.
Bye-bye.
Thank you, Chair.
Thank you.
Bye-bye.
Okay, bye-bye.
Those attending ethics training will kick off momentarily on this line.
I should hang out.
Everyone, we'll give folks a couple of minutes to start